Welcome to this session. This session is going to be on the computation part of profits and gains of business or profession. We have already seen the legal provisions, the Income Tax Act, the provisions given in the Act, the methods of calculation of depreciation, methods adopted in various blocks of depreciation. Then we have also seen some of the most important aspects relating to scientific research, what is compute and what is allowable expenses, what is not allowed expenses, and things like that. Now we are going to have a hands-on situation on various assessees, how the income profits from the business or from the profession is going to be computed as per your Income Tax Act is going to be discussed out here. With some numerical examples, we are going to look into it. Now, in computation of the profits and gains of business or profession, we have to go with this particular format that the pro forma for computation is developed, and that is presented on your screen as of now. We have always, we normally go with the financial results of a particular business or a profession. We are going to add certain deductible expenses that sorry, not deductible, but then we add some of the expenses which are also being debited in the statement of profits and loss, or but then it is not going to be allowable. So which is not allowed, it is going to be getting added back to the net profit, so that your net profit will get added up. So it will be showing a escalated amount. And we are going to deduct some of the expenses which are going to be allowed by the Income Tax Act to be claimed under the income from business or profession. So we have always got to start out with the net profit as per the statement of profit and loss account. So we are going to have a start out like your net profit from your net profits or the losses. That's the starting point of computation of your income from a business or profession. With this net profit, we are going to add some of the expenses that has been debited. Okay, add some of the expenses that has been debited in the profit and loss statement, but then it is not going to be allowed by the Income Tax Act. Let us say some of them. Now, the depreciation as per the books of accounts, then the income tax that's disallowed under section 40A of section 2. 30% of the sum payable in respect of to the resident on which the tax is not going to be deducted at source or has not been remitted on or before the particular date under section 139(1) of the Income Tax Act. Then any expenditure incurred in respect of which the payment is made for goods, services, or facilities to a related person, related to the person, to the extent of the same is excessive or unreasonable in the opinion of the Income Tax Act. Authorities of the Income Tax have to be added back. So that's not at all allowed by the Income Tax Act. And then any expenditure incurred in respect at which the payment of or the or to be paid in future to a person in excess of 10,000 rupees in a single day and made otherwise than by way of account pay check or demand draft or something like that. So anything related to in modern cases in electronic mode, if you look at the debit card payment, credit card payment, then your through your net banking, RTGS, NFT, I mean NEFT, IMPS, BEAM, other pay, all these are going to be under section 48 subsection 3. They are all going to be disallowed. So they are all going to be added back to your net profit. And certain sums payable by the assessee which have not been paid during the relevant previous year in which the liability was incurred on or before the due date for the filing of the return. So anything which has not been before the filing of the return, which have not been charged out, and that kind of an expenses are also not allowed. Then the personal expenses, all personal expenses not related to the business, they are all going to be not allowed to be deducted from the business. And then capital expenditure, they are all not allowed as per section 37 of the income. Then you have got going to be of capital nature allowable as per section 30 and 31. Amortization of the preliminary expenditure under section 35D and expenditure incurred under section and voluntary retirement schemes and under section 35 DDA. 4/5 of such expenses are not going to be allowed or added back. So then uh, a fine or a penalty paid for the infringement of breach of contract, breach of law. However, some penalties in the name of the damages for delay in payment or completion of a particular contract being compensatory in nature is allowable. But other than that, any fine penalty paid for infringement of or breach of law, they are all not going to be allowed, so they are going to be added back to the net profit. All expenses related to the income which is not taxable under the head of income from business or profession. For example, municipal taxes, normally that will be paid in the, that will be claimed in the uh, income under the head of house property for purpose of residential house properties that is going to be paid. If it is deducted in the net computation of net profit of a business, that becomes a personal profit, personal expenses one point, and that's going to be claimable only under the head of your income from house property. So that expense is not going to be claimable under this head. So that is also not going to be allowed. So that is added back. And any sum paid by the assessee as an employer by way of contribution to pension schemes under section 80 CCD exceeding to the 10% of the salary of the employee, they are also not going to be allowed. So anything below 10% can be claimed, but anything after, above 10%, it's not going to be claimable. All these expenses are going to be added back to the net profit, assuming net profit for the year for the assessment period is going to be A. All these total of expenses are going to be called as AB, and A plus B will be your total amount of C, whatever you are going to get. And from this C, you are going to subtract certain expenses which are allowed as deduction but not deducted debited to the statement of profit and loss account. So far, you would have not debited it. So in such cases, such kind of to be debited expenses can be deducted from your income, from your net profit of the firm. So in that case, some of the expenses are listed down here. See, for example, the depreciation computed as per Rule 5 of the Income Tax Act, Income Tax Rule 1952. So all these depreciation blocks, 5%, 10%, 15%, 30%, 40%, whatever be the depreciation which is not being claimed so far, that can be claimed out and that can be deducted from your net profit. And any additional depreciation 20% of the actual cost of new plant and machinery acquired by the assessee engaged in the business of manufacture or the production of any article or things or or generation, transmission of distribution of power. 10% of the actual cost can be put us to us less than 180 days. So if it is going to be used for 180 days, you can claim 20% of the actual cost, or in the case of power generation, 10% of the actual cost can be treated out. That claim can be deducted. And then the balance additional depreciation at the rate of 10% of the actual cost of plant and machinery acquired and installed during the previous year, whatever it is, 2021, 22, 23, whatever it is, and put to use for less than 180 days. These all can be subtracted out. So C minus D, all these total I'm going to call it as D, and this C minus D, you are going to have it as F. E. And from there, some of the incomes that is going to be credited in the statement of profit and loss account, but then um, it is not going to be taxable, or non-taxable income can be subtracted out. So in this case, a dividend income is one such example. Agricultural income exempted under section 10 can be another example of it. And list of all these income, the same like interest on securities, savings bank account, FD, taxable, and in fact all these interest incomes are going to be taxable under the head of other sources. So you need not show it here. So that should be subtracted out. And profits are on sale of capital assets taxable under, any capital assets which is going to be sold out, they are going to be taxed under the income